Are you prepared for a financial storm brewing on the horizon?
Today, we're gathering crucial insights from inflation expert Willem Middelkoop, who warns about soaring inflation rates.
And the beautiful part? We summarize complex analyses into digestible insights just for you.
Exactly. Discover how geopolitical events are setting the stage for potential economic upheaval.
Welcome to Financial Insights in Minutes, where we transform expert analysis into valuable knowledge.
But stick around as we're diving into an upcoming analysis featuring Snider and the repercussions of a global recession.
Anchors away as we dive into the stormy waters of soaring inflation.
Let's get straight to the facts. Willem Middelkoop forecasts inflation possibly exceeding 10%, driven by rising geopolitical tensions.
So what's fueling this inflationary fire? What's the core message from Willem today?
The main thesis highlights that geopolitical tensions, particularly in the Middle East, could push inflation beyond 5% and possibly reach double digits.
Let's dissect those key points. What's happening on the geopolitical front?
Current tensions suggest a spike in oil prices, causing worries about inflation affecting food and essential goods.
And how's the commodity market reacting?
Very nervously. There's a significant chance that as military tensions rise, oil and other commodity prices could follow suit.
Looking ahead, what should we brace ourselves for?
Willem anticipates inflation may soar to above 10% again, questioning the stability of our current financial framework.
What does he predict for inflation as conflicts rise?
Higher inflation and social unrest could ensue if tensions escalate into broader conflicts.
And how will markets respond to potential stimulus measures?
Historical trends indicate markets rebound sharply, but with increasing inflationary pressures looming.
In summary, what's the takeaway?
Investment strategies should pivot towards commodities as preparation for the inflationary storm ahead.
But wait, stay tuned for insights on how inflation will impact the global economy next time.
Coming up next, an in-depth look into inflationary pressures with insights from Snider.
Anchors away on our next topic. Is Phase 2 of the global recession finally upon us?
Let's get straight to the facts. Snider indicates that coordinated moves across critical macro statistics are sparking concern worldwide.
What a storm to navigate. Just how profound is this awareness shift within the global economy? So what's the anchor pulling at our economic ship?
The core thesis posits that the economy hasn't fundamentally changed. Instead, perceptions of its real situation have reached new depths.
Let's break down those pivotal ideas, starting with the rate cut situation. What's the scoop?
Snider highlights that just months ago, the idea of rate cuts was off the table, but recent events have pushed the Fed to make sudden cuts, sparking concern.
And regarding inflation, what's the latest trend?
The shift in inflation expectations has shaken central banks, which are now panicking as the economic landscape changes drastically.
What about this concept of disinflation?
Disinflation is sweeping the globe, with consumer prices unexpectedly dropping and catching officials off guard.
So, looking into the crystal ball, what are Snider's predictions?
He foresees a wave of reactions from central bankers as they scramble to address the rapidly changing economic signals.
What's next on the global stage?
There may be a push for greater global economic coordination to stabilize markets amidst widespread disinflation.
In summary, what crucial insight does Snider leave us with?
He underscores the urgent need for robust economic strategies. Central banks must navigate these tempestuous waters carefully to restore stability.
But hold on to your hats. Coming up next, we dive into insights from Game of Trades on gold is sending a major warning.
Trust me, you won't want to miss this intriguing discussion.
Anchors away. Today's topic is shiny. Gold prices are sending us some serious warning signals.
Let's get straight to the facts. Historically, gold tends to rise ahead of major economic downturns. Is history repeating itself?
Now that's a treasure map worth following. But what patterns are we seeing today that might indicate trouble? So, what's the central theme from our guest today? What can golden nuggets of wisdom tell us?
The core thesis is that rising gold prices might forecast a downturn in economic growth. The correlation between gold spikes and previous recessions is striking, especially when economic shifts are on the horizon.
Diving into our key points, what's the historical pattern here?
Gold historically tends to surge before severe recessions, such as the ones in 2007 and 1973. However, it remained stable before lighter recessions in the 80s and early 2000s.
What's up with the relationship between gold prices and the economy?
There's this intriguing inverse relationship. As gold prices rise, it's usually a sign economic growth is stalling. Investors flock to gold as insurance against currency devaluation.
Now, let's discuss current trends in gold pricing.
Gold is up 34% this past year, but it hasn't reached those alarming peaks we witnessed before 2008. It's more of a gentle warning light right now.
What about global factors influencing the gold market?
China's real estate crisis is significantly impacting investor sentiment, pushing many to invest more heavily in gold as a stable option.
Now, what does the consumer aspect tell us?
Consumer savings are at a perilously low state, reminiscent of pre-crisis conditions. A weak consumer often signifies a shaky economic foundation.
Looking ahead, what's the forecast based on these signals?
The considerable rise in gold suggests that fears of an economic slowdown are rising. With dwindling consumer savings, what's next for the U.S.?
And what if these trends continue?
If consumer patterns remain shaky, we may be on the brink of another major economic crisis, just like 2008. Gold's patterns might be our best warning sign.
To sum it all up, what's the main takeaway?
Rising gold prices are a clarion call indicating possible economic troubles ahead. It's a sign that investors are wary. Time to stay alert and keep those financial life jackets handy.
But don't change that dial. Up next, we have insights from Tom of FX Evolution to explore some jaw-dropping market predictions.
It's going to be a whirlwind discussion you won't want to miss.
Anchors away. It's almost time to navigate the turbulent waters of non-farm payrolls.
Here's the scoop. These numbers are crucial for market movements, especially with the Fed's current focus on job stats.
With the stakes this high, what are Tom's insights on what could happen next? So what's the big thesis here? Why should viewers brace for impact?
Tom emphasizes that the non-farm payrolls will likely determine the future direction of market trends and the Fed's monetary policy, shifting from inflation concerns to job metrics.
Let's dive into those key points. What's the buzz around non-farm payrolls?
According to Tom, this report has shaped markets since 2018, and it's about to get very volatile.
What do analysts predict for the markets?
Tom reveals JP Morgan's stats, while Goldman Sachs predicts a bullish start despite some October bumps ahead.
What do the charts say about the current state?
Tom notes that many indicators show the market is overbought, hinting at a potential dip before a recovery.
What's Tom predicting with the job data?
He predicts that the upcoming job figures will dramatically adjust market sentiment, steering investment strategies for weeks.
What's coming in October?
Tom foresees a volatile October with possible shifts in interest rates that could either amplify or mitigate risks.
To wrap it up, what should viewers take away?
The non-farm payrolls are crucial. They dictate the health of the economy and signal potential shifts in market dynamics. The forecast looks balanced between risk and opportunity.
And what about the takeaway on navigating the markets post-report?
Expect the unexpected. This jobs report could be a game changer for your investment strategies.
But hold on to your hats. Coming up next, insights from Louis gave on a significant shift in market dynamics.
Stay tuned as we delve deeper into market sea change underway as Asia repatriates capital from the West.
Anchors away. Let's explore how Asia's capital repatriation is reshaping global markets.
Here's the scoop. Louis gave reveals that Chinese investors are shifting their money back home, which affects where the bull markets are heading.
Just when we thought the waves were calm, this trend could signal a tsunami of change. So what's the central thesis here? Why is this repatriation movement critical?
The core idea is that this influx of cash back to China could invigorate growth and shift investment focus away from the U.S. tech sector, opening doors for more cyclicals.
What's the situation with emerging markets?
Emerging markets have been on fire, with China's stimulus efforts rejuvenating the investment landscape.
What's the story with China's fiscal environment?
China is flexing its monetary might, positioning itself to sustain a trade surplus while stimulating growth.
How do geopolitical issues play into this scenario?
Well, rising tensions in the Middle East remind us that sudden spikes in oil prices could derail these growth expectations.
What are the predictions for Asia's investment landscape?
It's likely that we'll see a long-term shift in investor sentiment towards undervalued Asian stocks as confidence grows.
And what about market reactions to global events?
Market volatility could ramp up, especially if unexpected geopolitical events unfold.
As we conclude, what's the summary of Louis Gave's insights?
The focus should pivot towards Asian opportunities, particularly in sectors that are undervalued yet have bullish momentum.
If you found value in these insights, consider subscribing for more.
Your engagement supports our mission to keep you informed and help navigate these changing tides.
Well, that's quite a roller coaster of insights we've been through today.
Absolutely. All our guests highlighted the pressing issue of geopolitical tensions playing a pivotal role in the economy.
And don't forget the heavy talk on inflation. Middelkoop believes we could see rates soaring above 10%.
Meanwhile, Snider's alarm about declining hiring rates is a stark warning about an upcoming downturn.
We also heard Gave discussing the shifts in Asian investments that could reshape Western finance.
Yet, Karl Eggerss tempered that optimism by predicting potential market panic.
Clearly, these experts present a mix of cautious optimism and alarming predictions.
That's right. To navigate these turbulent waters, make sure you're well informed.
Like and subscribe to our channel, Financial Insights in Minutes, so you won't miss out on our latest discussions and expert insights.
And while you're here, check out our other videos. There's a treasure trove of knowledge waiting for you.
Stay ahead of the curve and prepare for what's coming next in the financial world. Until next time.